So in terms of, we've got a slide up there in terms of saying getting out of the big five. Someone's added an extra one. St George have snuck in there as a big five, I don't know. But Jeremy, where did the big five come from?
Oh, St George, mate. I've got a soft spot for St George. I personally bank with St George. I couldn't see him left out.
Okay, so we've got an extra one. We've got St George for Jeremy. He likes the friendly dragon. So again, we've said the reasons why you potentially want to look at getting out of some of the big banks, and it's not just the big five; it's the other ones. And we've got a couple of second-tier lenders on the screen there. Liberty and Pepper. And the way they will assess your loans is different to the way the APRA guidelines of a lot of the major banks. So even though they've sort of, tightening a little bit and at the moment, and it is getting a little bit more difficult because they're still bound by ASIC and the living expenses and so forth. So, but there is options, and you've got to weigh up your options in terms of looking at those interest-only expiries and saying, am I, from a repayment point of view, when I'm looking at what my repayments are going to go to in the future, am I better off to look at my options, even though it might be going on to a higher interest rate, but looking from a cash flow and looking at my long-term picture that my property's to hold my portfolio for the longer period of time, is that something that I want to consider doing? Or can I extract some additional funding to do something else, or to use as a buffer if I don't have a buffer in place to be able to do that? So that's some of the reasons why people are considering those. And outside of those, there are some other funders. That they're not on our Aussies lending panel, but I've heard of them. And some of the things that you need to consider about these second or third tiers, or there's private funding, there's a number, is quite often they'll charge you an upfront fee, similar to like a mortgage insurance type fee. We had a mutual client the other day who was looking at the options to buy a home, and he failed with all the sort of the second, and so he was looking at more a third and fourth tier, and the upfront cost was going to be something like $35,000.
The establishment cost, depending on where you go, could easily be anywhere between 1 to 2% plus the GST as the charging. Right? So it's about 2.2% is quite sort of common. So when you look through a loan of say $1 million of 2.2%, that's quite substantial. Now on that example is that in our case is that the gentleman desperately wants his principal place of residence. We understand our dream as it is, right? But from his perspective is that he was going to go through a lender where the interest rate was almost about 8.95%, 9%, the initial cost and all the rest of the cost. And this is where you sort of say that, what is the line to draw and what's the practicality, and are you better off to wait for a bit?
So, it's just because they will lend you the money doesn't mean you should. You still need to do your numbers, run it by your accountant and so forth, and look at not just the headline rate, but look at what the fees are associated with those. And because and we have seen the lenders and going back cycles. Around the GFC, where if I was to go back to 2009, some of the rates with these second and third tier lenders increased more than your major lenders because they're not in the spotlight as much as the Big Four. If the Big Four were to go and raise rates by 0.5% or 1%, it'd be frontline newspaper on the papers. But some of these second tiers, once they've got you in the system, may slightly raise the rates up.
I suppose, Ross, one of the other things which I'm seeing quite a bit now is that, and it's interesting because I've seen that in the previous cycle as well, more towards the end of the previous cycle, is the load of loans to sort of progressively start to sort of come back into the market. So we just had a recent example of 2-3 number of sort of investors' point of view that there is this prospective load of loan where you self-declare, I suppose, your income, saying that, well, as a self-employed, this is what my income is. And as long as you can, to some extent, half justify it, the line sort of goes through and so forth. I suppose where one needs to be cautious is that the numbers still need to be correct. even though you are not substantiating with all of your detailed financial accounts and the returns and so forth. The risk to me in my mind is that very often many of those information are data matched. And while they're sort of a data matched, it's a matter of time before sort of ATO sort of picks up saying, hang on, this is what you're declaring your income is, this is what your set of accounts and the tax return is showing. So there is a significant level of difference. So a bit of a desperation that I'm sort of seeing on the market, whether it is coming in as a panic.
Yeah, I mean, under all lenders, and regardless if it's for residential or individual borrowers, even if the lenders are doing low doc, and there's not really much such a thing as a low doc, they call it medium doc. They want some form of proof, whether it's a letter from accountant, whether it's BAS statements, whether it's bank statements. There's a number of things that they'll want to see to justify your income, because they're still bound by the laws, right? It's but obviously, we are seeing some of those options come into the play, but a lot of our investors, and will look at a second tier lender like a Pepper or a Liberty, because it is still a good option, right? So, and Paul was talking about some of the properties that he's purchased, and I was chatting to a few of the other clients, and the money that they've made long term from going into those different deals. So you've got to weigh up the opportunity cost. Of course, everything has its risk, and with property investment there is risk, and it's about how do we minimise those risks. So Munzril's mentioned cash buffers, making sure that you've got cash buffers in place, looking at your insurances, reviewing your rents, looking at in advance at your interest only dates, and not coming to that point where saying I can't afford it. No, 12 months, 2 years in advance, and you might need to liquidate a property to provide you some buffers moving forward. So it's about planning, and that's really is definitely, and my suggestion is don't wait, don't be ignorant, don't put your head in your sand saying I'll deal with it when it comes. Put a plan in place to be able to do that.